everyone, welcome back to our Accounting 210. In this video, we will look at our chapter 12, the practice. So now let's get started. I think I put a lot of questions there. I'm not going to cover everything. I just want to, review the most important part, and then I think I put a lot of practice there for you. So let's get started. Chapter 12. Chapter 12, what did we learn? Chapter 12, what did we learn? We basically learned capital budgeting, right? Capital investment. So we said that the general idea is how do we spend the money? We want to find out what's the best way to spend the money. So basically, the textbook give you two big parts. The first, we said, hey, we do not worry about time value of money. We think the money today is the same as money next year. If you follow that logic, there are two methods that you can use. One is the payback, right? So we want the payback to be shorter. We want to get our money back faster. And then we also have the accounting rate of return. This is the only way focusing on the accounting. How do we get that? We need to use your cash and then subtract the depreciation expense. But then we said that that's actually not the reality. $1 today definitely worth more than $1 next year because of time value of money. So we have a very big important concept is talking about time value of money. I just put it here, right? And then we said in chapter 12, we focus on the present value. We focus on the present value. We said, hey, you have $100 after 1 year. Sorry, it's after 1 year, right? And then we said, what's the present value? We have to discount this back. We have a fancy name called discounted back to get the present value. So if we follow the time value of money and discount the cash flow, we will have two extra methods. One is called the net present value. So this is the present value and you have to net. The other one is IRR. This is when the NPA equals to 0. So you have to, chapter 12 is very, very, very important. You definitely have questions there and then very useful for your life. I really personally think everybody in school of business should know the concept time value of money. Okay, so now let's look at some questions together. A process of making capital investments referred to capital budgeting. I think that's right? I leave those concepts actually basically to yourself. I trust you better. Your English is much better. You are younger, you are smarter. So let's see. Okay, next one. The following are all methods of analyzing capital investment except regression. No, regression is chapter 7, 6, right? It's talking about cost behavior. We have payback method, ARR, NPV. So regression is not investment. Next one. Which of the following item would be considered a capital asset? Capital asset is a long-term assets. Okay, long-term assets. New store building. Yeah, this is capital asset. This is capital assets. Purchase office supplies. No, you will use immediately. No. Payment for this year. No, this is your expense, right? Advertisement expense. Donation of money. No, you don't donate money. It's not investment. Next one. Which of the following is character of capital asset? Item involve a signature. Yeah, it's a lot of money. Will be used for. Yeah, it's a lot of time. So it's both A and B here, right? And then next one. The term is a formal means of analyzing long-range investment. So that will be capital investment, capital budgeting, capital investment. Next one. Accrual-based accounting is not used in determining the accounting. No, it's used, right? So when we use the ARR, we have to use accrual-based. So it's not used. That's wrong. That's wrong. It's used. Okay. Next one, payback method, focus on profitability and not time. No, this is wrong. So this is one bad thing about the payback method, right? We said it's only focus on time. We ignore the overall profitability after the payback. So this is wrong. Next one. Okay, next one. The accounting rate of return uses non-cash flow factor, including depreciation, in calculating the operating income of the assets. Oh, this is a good one actually. The accounting rate of return uses non-cash flow factors, including depreciation, in calculate the operating. Yeah, so you have to use the cash subtract the non-cash, which is the depreciation expense, to get the operating income. Okay, so I guess it's true. Oh, I'm so smart. Oh my goodness. Okay, next one, investment with a longer payback method are more desirable. No, we want to have a shorter, right? So this is false. Hey, well, I'm so smart. Hey, my students, hey, you know why I'm so smart? The term best describes the length of time required to recover the cost. So this is the payback, right? This is the one you focus on the length of time. Okay, next one. Oh, wow, let's look at some calculation. Okay, so you have this, you have that, asking you payback period. So payback, we said, basically is very straightforward. We don't think time value of money. So it's your investment, right? Basically your investment divided by the cash flow every year, and then we don't need to discount. So then you don't need to worry too much. It's asking about X. Investment is 900,000, and then every year, you don't worry about how many years. Cash flow for 8 years, every year is 115,000. Sorry, this is divided. Sorry, somebody told me that my handwriting is too freestyle. I think I need to be more careful. So we don't worry about residual. We don't worry about depreciation. We don't worry about return. We don't worry about how many years you need to calculate the years. So that's 8. Don't worry the extra information. So 900,000 divided by 115 gives me 783. 783. Okay. Okay, next one. That's the next one. Asking about payback for proposal Y. I leave this one to yourself. I leave this one. So you use investment divided by the cash flow every year, right? Next one, asking you about accounting rate of return. So we said the accounting rate of return. So this is how do you get it? It's your, I need to think about, it's accounting. So we use income. So your income is the cash minus depreciation expense divided by your investment, because we think about the return based on the investment. So our first step is get the depreciation expense, then we convert from cash to operating income, then we do this ratio. So asking about X, we need to think about depreciation expense, right? Depreciation expense every year. Depreciation expense is your cost minus your residual divided by years, right? Divided by years. So your cost is 830,000, and our residual is 68,000. And then how many years we can use it for 80 years. So your depreciation expense every year will be 830 minus 68, and then we divide it by 80 years. So every year is 95.25, 95. But they said round this to the nearest dollar, so it will be $95, right? So it will be $95. I put 95. So this is your depreciation. And then your cash minus depreciation expense. Your cash is 105. Everybody says that. So it's 105 minus 95 gives me 10. And then we use this 10 to divide it by 830,000 investment, right? Everybody knows how I got this number. So you have 10 divided by 830. You get, oh goodness, you get what? You get 1.20. Hey, 1.17. I believe this is should be 1.17. 1.20. 1.20 is similar with 1.17. I don't know why I didn't get the exact number, but this is what I get. Oh, I'm so smart. I'm so smart. Goodness, I'm so smart. Okay. Next one, I believe is similar, but I ask you to do the proposal Y, so you do it by yourself. Next one, let's look at the next one. Hey, I'm so smart, right? What's the next one for? So I think I put more practice for accounting rate of return for you to practice. Project 1, we said still you use your cash, you subtract the depreciation expense divided by your investment. So let's say first step is always get your depreciation expense. And then how do you get depreciation expense? Is your Is your investment you spend 300,000 minus residual 36,000 and divided by how many years? 6 years, right? 6 years. So we don't worry about required rate of return because we don't even think about the discounted cash flow. So we don't worry about that now. Let's see, 300,000 minus 36 gives me 264. And then my cash flow, give me one, sorry. Hey, okay, my cash flow, instead of cash flow, okay, cash flow is 110, right? So my cash flow 110 minus, what? Hold on. Hold on. What did I do wrong? Okay, hold on. Oh, hold on. I forgot to divide it by 6. Look at what I'm doing. Sorry, I'm not smart, okay? Okay, I take back my words. I'm not smart. Okay, minus 44. Okay, so 110 minus 44,000. Everybody knows what I didn't get. I forgot to divide it by 6. Okay, now I use my cash flow is 110 minus 44. I get 66,000. So my return will be 66,000 divided by my investment 300,000. So we use that divided by 300,000. We got 22%. Oh yeah, I believe it's right. Okay. And the next one, I believe I want you to do the project 2. So similar, I leave this to you. Next one, the payback period. Okay, this should be easy, right? So we still talk about payback method. We said payback method is just you use your investment divided by years. It's asking about Indiana proposal investment is, let's see, think about this one, 5-story Indiana cost is 1,810,000, and then under this proposed company would focus on Kentucky and open six. The other is this, okay, and then this is your investment, and then every year you don't worry about residual, don't worry about life. Every year is 500,000, and that's it. You just need to focus on the useful information. Okay, so it will be 1,810 divided by 500,000, so we got 3.62 years. That's it. Don't worry about those fancy numbers. We don't need them actually. Okay. Next one, I believe I'll ask you about Kentucky. You know. Next one, payback method. Okay, still asking about payback method. You have to be the photocopier. What useful. You don't worry. You cost $700. You cost $7,540, and then annual cash flow will be 2,200. So basically, the logic is you spend 7,540 to buy this printer, and every year you will save 2,200, right? So general idea is how many years it takes to get your 7,540 back. That's it. It takes 3.43 years to get your printer back. So once you pass that, then every day is just you got you kind of positive, right? Positive. Before that, you are still paying off your investment. That's the logic. Okay, next one. Asking you about the accounting rate of return. So we still say it's the ARR, right? So still the cash minus depreciation expense divided by investment. So let's look at this number. Evaluate capital investment project will require initial investment. So your investment is 65,000. I put there. I have 80 years residual is this. So I'm not going to put, you should know this. Required the cost is 65,000, residual is 7,000, and then will be used for 80 years. So every year, every year depreciation is 7.25, round this to the nearest dollar. So it will be 7. Oh, I know why I did. I think I skipped the 1,000. Okay, so it will be 7,250, right? Okay, so depreciation will be, this is 7,250. Okay, and then the cash is 15,000. Okay, so the cash is 15,000. Oh, I see. Okay, I thought, yeah, you are right. Okay, sorry, 15,000 minus 7,250. And then you divide it by your investment is 65,000. Okay, so you get 11.92%. Yeah, I think this is the right answer. Oh yeah, oh yeah, oh yeah. $1 to be received in the future is worth more. No, that's just the opposite. A dollar today worth more than a dollar in the future. One advantage of the internal rate of return is considered time value. Yeah, that's right. That's right. And then next one, the net present value method doesn't incorporate. No, it includes. Okay, it includes. Next one. The term is best a stream of equal installment made equal time. So that's our annuity. That's our annuity. Next one. Okay, next one. Asking about how do you get present value, right? So we said present value is just your future value times the discount factor. So your grandma probably to give you 1,500 a year at the end of the next. Oh my goodness, I wish I had that grandma. Give me that grandma. So okay, keyword, right? At the end of each year for next 4 years, okay? If you earn C or better, wow, in all of your class, that's not hard. My accounting 210 students can do this, right? Okay, so hey, stop joking, right? So well, what's this? What I want you to pay attention. At the end of each of the next 4 years, so this is annuity. This is annuity. So we have to use annuity factor. We have to use annuity factor, and then 7%. N equals to 4. Hey, those are the same. What's the, so you need to use the present value factor for sure, because you calculate the present value. So you use the present value factor. So the choice says future value factor. We focus on present value. Okay, next one. Okay, I think I stop. After doing 30 questions. I'll make another next video. So let's say you won the lottery and have a number of choices. How to take money, which choice you will give you more money. One is the 84,000 lump sum 6 years from now, and then 81,000 6 years from now. Oh, 47 now, 9,000 a year at the end of the next 4 years. Wow, so you have to calculate, right? So the first one is 84,000, but you need to wait for 6 years, and every year is 6%. So you need to use $1 amount, okay? So you need to use $1. 6 years, 6%, okay? Point 705. This is choice A. Choice B is 81,000. But you use 6 years, but 5%, okay? Time 0.746, okay? So 5%. Choice C is 47,000 now. Choice 4 is you use at the end of next 4 years, add a year for whatever years, right? So a year at the end of each of the next 4 years. So you need to use annuity, okay? So you need to use annuity 9,000 time next 4 years using 5%, 3.546. Okay, so this is the present value of this one. Present value. I'm too lazy. I'm not going to press my Excel, press my calculator. So I leave this to you. You just pick the one with the highest amount, right? You want to have the highest amount. I have no idea, honestly. I don't know. I cannot choose any answer for you. So I don't know. You need to. But this is how you do. Hey, how about we do this? Sorry, I wasted your time. Sorry, 84,000. Why I want to be lazy? I cannot be lazy. My students are waiting for me, right? 7 times 0.705. So this gives you 59, 220. Okay, second one gives me 81,000 times 0.746. So gives me 60. Okay, second one gives me 6426, right? Okay. So third one is 47,000. Last one is 9,000 times 3.546. I got 31,000. Okay, answer is B then, right? Answer is B. Okay, am I right? Oh yeah, now you know you have learned this. It's very useful for your life actually. Okay, I think I stop here. I need to get some food and water. Sorry. I see you in the next video, and then we definitely can finish everything just in one video. I see you in the next video. Thank you. Bye.